Miller's Legg Mason Value Trust made its name in the 1990s for consistent returns in what became a 15-year streak of beating the S&P 500 that then ended in 2006. Since then, the road has been rockier, but Miller and his team say now is the time to buy large-cap U.S. stocks. Here to discuss the fund strategy is Mary Chris Gay. She's a portfolio manager who works with Miller and has been with Legg Mason since 1988. Mary Chris, thanks for coming in. Nice to see you. So, obviously, the trust frequently is looking at large cap U.S. stocks, but why do you think now in particular is a good time value-wise to be looking at these kinds of stocks?
When you consider the environment that we've been in and the returns from 10 years ago, there's only one other time where the trailing 10-year returns for the market were negative, and that's back in the Great Depression. So if you consider the severity of the downturn and the fact that large cap U.S. stocks are cheap on almost every valuation metric, 10 years ago, people wanted U.S. stocks at almost any price, and today, U.S. equities are among the lowest in terms of ownership that they've been in some time. So when we look from a valuation standpoint at the opportunities, especially for large cap U.S. equities with growth opportunities outside the U.S., given where they're trading at, given the strength of their balance sheets, the strength of their cash flows, the strength of the growth rates, they're just really exceptional bargains, we believe, today.
Now, I'm curious, you mentioned trailing PE as one of the indicators you guys look at. I'm curious, when you're trying to decide what is good value, is that the most important indicator, or what are some of the other measures you all use?
So we look at quantitative factors as well as qualitative factors. So we're always looking to see where stocks traded out on a relative basis based on PE, price to book, price to cash flow, but we're also looking at what the returns on invested capital for companies are relative to their cost of capital. Obviously, all of the data that you can mine about a company reflects the past, and all the value creation is based on what it will do in the future. So what we're trying to do in our approach is model out at least 10 years, because we don't know at what point of the economic cycle we're in or how long this stage will last, and we try to look through a complete market cycle, and we look back at a company's history to see how it behaved through the market cycle, and also, going out in the future where we think the returns are likely to be and what the sustainability of those growth rates will be.
Well, and you also, of course, look at sort of broader market trends, and it was interesting when we talked in advance of this, you pointed out 2004 as perhaps showing some parallels to this year. Can you explain that?
Sure. If you consider where we were at the beginning of the decade, we had 3 years in a row of negative returns, the first time that's happened since 1939 to 1941. So there was a lot of pessimism, a lot of fear and uncertainty in the market. In 2002, we had the famous debt deflation scare that Ben Bernanke discussed in his November speech of that year. We had the Enron, the WorldCom 9/11, and there was a lot of angst in the market. And 2003 really surprised investors on the upside. We had a really remarkable year for returns and much better than expectations. But as we went into 2004, fear began to creep back into the market, and on a year-to-date basis, actually, the returns in 2004 are not too far off from where we are this year.
But then, of course, at the end of 2004,
we had
things turned around.
Right, and part of that was ushered in by just the certainty surrounding the elections, not too dissimilar again to the uncertainty that we have today on the direction of policy decisions and what the economic impact of those decisions will be on companies. So we believe that when you look at the news flow has been very negative, but if you look at the companies and what they've been reporting, above expectations in some cases, and they've been making great strides to shore up their balance sheets. In the case of the financials, they've essentially recapitalized in the midst of the financial crisis, and balance sheets are in really good shape. Many of them are still trading, though, at a discount to their book value. And we heard from J.P. Morgan not too long ago that they're looking for some guidance on where dividend tax policy will be, and assuming it's here or not too far from here, then they will likely resume to a normal payout ratio.
Now, I mentioned going into this, of course, that the Value Trust had a 15-year streak there, and actually, if you look over the life of it, going back to the early 80s, it's outperformed the market on an annual basis. But the last few years, I'm sure, have shaken you and the team over there. When you strategize now, how have you changed what you do? Do you do a lot of second guessing? Is it tougher now because you had that outperformance and the pressure is on. I'm just curious about the approach, how it has changed, perhaps.
When I joined 21 years ago, it actually was in the midst of a period of underperformance. So the record goes back almost 30 years. And over that time period, we've had 2 periods of underperformance, significant underperformance. We've had shorter periods, but those 2 periods also coincided with what we believe is described most accurately as a collateral-driven crisis. So when our investment process has always had an evolutionary type of approach. We're always trying to look for new valuation techniques and new ideas, new ways to solve problems to lead to a better understanding of a company's value. So when we went back after that period of underperformance in the late 80s, we actually made some enhancements to our investment process, and we were in the 99th percentile of managers at that time, not too far off from where we are today. And those enhancements led to our ability to identify values in technology at a time other managers, value managers in particular, didn't have a lot of exposure there, and led to really terrific returns through that decade. We did the same examination of our evaluation approach after this period, and actually formed a risk evaluation committee in 2008 to examine the inputs to our investment process, both on a portfolio stock selection basis, but also broader awareness of just what was going on in the overall market, to see if there were signatures that we could have identified that may have led to different decisions.
Now, I'm curious, I mean, specifically at that time, you all have made a bet on the banks recovering. That didn't happen, or it didn't happen quickly enough anyway. Once again, you guys have about a quarter of the portfolio in banks, the big money senator banks, the JP Morgans, the Citigroup, the Bank of America. Why do you think that now you guys are going to be right and these banks are going to go up?
Well, clearly we made mistakes during the downturn, and one of them was we underestimated the severity of the financial crisis. And recognizing that now, because we've had a long history of owning financials in the fund, and if you think back to long-term capital management, in 1998, the markets were actually doing quite well right up until the summer, and then when we had the Russian debt default and long-term capital management, financials went down over 50%. The right strategy in that liquidity-driven crisis was to actually buy where the greatest fear and pessimism was, because once the situation stabilized, the market took off and valuations normalized. And part of the reason why we did so well that calendar year, up almost 50%, even though we were behind the market, not too far from the end of the year, was because of our courage or willingness to really separate the emotions from the fundamentals that was going on in the market. This crisis, because it was a collateral-driven, we really needed to identify the point of the market when collateral was stabilized, and that didn't happen until October of 08, and the right strategy should have been to be more defensive. When we look at financials on a normalized earnings basis going out over the next 2 to 3 years, they are trading at, in some cases, half the market's multiple. They're divesting of the more volatile parts of the business in some cases, some of the trading businesses, which does create a greater deal of earnings uncertainty and volatility. So if in this regulatory environment where we have an ability to model out and predict, or believe we can predict where returns are likely to be, we think that the valuations here at such a tremendous discount is unwarranted.
All right, Mary Chris Gay of Legg Mason Capital Management, thank you so much for coming in. Appreciate it.
Thank you.